Welcome to Ground Zero, episode 1 of On Point with FirstPoint. I'm Troy Phillips. I'm here with Chris Pryer. We've decided to do a podcast. And the first thing I said to Chris when we decided to do this was, why? Because the world needs another financial services and property podcast like an acai shop. And a lot of people that jump into these podcasts are potential psychopaths or serial killers. I don't know why they do it, but we're doing it for pretty simple reasons. I wanted to keep it. I wanted to make it 3.5 hours like Joe Rogan, long form, and munch gummy bears. But Pryor wanted to keep it about 25 to 30 and cover some serious issues. So, Chris, what are your thoughts when we jumped into this, mate?
Yeah, let's keep it real. It's more about just simplifying some of the information that's out there, and I want to talk about some finance topics, some property topics. Some other things we will go sort of wider than just that, but really simplifying some of the information and misinformation that's out there at the moment. And I think some really topical things that we can cover off today. We've obviously been a big week. We've got the RBA moving. There's a spike in the SMSF lending. Troy, I want to wind back the clock. I want to talk about the GFC and what you went through.
Some good stories there too.
There's some good stories there. There's a lot in that head that I want to download.
You were there. You were actually a young guy in that world with us.
That was such an interesting time. It was wild. There are some stories there. And then lastly, we're going to unpack our business throughout each podcast. But today, more importantly, we're going to lift the bonnet and talk about scale and our experience and sort of where we've made some good decisions and some bad decisions and what we've learnt from that. But Troy, I think we duck into the RBA 25-point rate rise. Rate rises are challenging, but they're a part of an economic cycle.
Yeah, it wasn't unexpected. I mean, it was. We knew it was coming before Christmas, didn't we? And I listened to. I mean, we're not a big bank, so you've got to have one economist to listen to. I take my time from a bloke called Warren Hogan, who advises Judo Bank. He's a well-known economist. He'd actually predicted that they'd gone too early on rate reductions.
Yep.
And I actually respect him a lot. But he was like, no. In my mind, rates should be going up, and they're putting rates down. And he sort of lost me a bit. I thought, this guy's lost it. And he goes, he's very confident. He's older. He's been around a long time.
Is he in Australia?
He's an Australian, Warren Hogan. He advises Judo Bank. If you want to, I'd actually Google some of his stuff. He's actually been around for years and he's actually switched on. But he called it. But he's also calling another couple of rate rises this year because he thinks if we don't get inflation under wraps, the outcomes are a lot worse.
Yeah, so that's something I want to touch on. What's nastier? Is it inflation or raising rates?
Inflation. Because what happens with inflation?
Talk me through that.
Well, with inflation is everybody thinks rates are a blunt instrument. The Reserve Bank can only increase rates anyway, but it won't have a huge effect on inflation. It's spending. Inflation means everything else gets more expensive, and your buying power of your dollar just goes down and down and down. So really, you have less money in your pocket. So we're actually at 3.8%, which is high. It was actually, and I think they call
cash rate.
No, 3.8% in inflation.
Oh, inflation.
Yeah, inflation. And the trim mean was 3.3%, that just takes all the stuff at Christmas spending out of it. That's huge. It should be around 2.5%, really, where the rest of the world's down in the 2s now.
Got it.
We're still sitting there. And sadly, the Reserve Bank governor, and it says the Reserve Bank has a lot of smart people, so you've just got to take it for granted. But the verbiage that Michelle Bullock put out was, it's consumer spending, and it's not. It's because the government's putting a lot more money back into the system and into people's hands, and it's actually getting spent. So it's not the first homeowners, it's not the people with mortgages out there that are doing a lot of the spending. In fact, they've really tightened their belts. If you talk to the hospitality industry, no one's out spending much money at all.
Well, small business is working harder than ever. And the results, it's not coming on paper. We're seeing financials. It's not harder work isn't resulting to higher profits.
No, the hourly rate, would you say the hourly rate for a lot of people that are SMEs in our market has gone down this year, and they're actually a bit despondent in some ways?
From what I can see, hours have gone up, and the commentary I'm having with these small businesses is hours have gone up and bottom lines have gone down. And there's obviously electricity costs, small businesses like you've got pubs, cafes, all of that. So cost of operating a business has actually increased significantly. Time spent on operating those businesses increased and profits have come down.
Well, you talk to a small business person, and I do it a lot because I want to know what's going on.
Yep.
And you get a great feel for hospitality, you get a great feel from the builders, you get a great feel from people that are in niche markets around construction. And their view is we collect tax for the government, and we have to pay our accountant to pass it on.
Yep.
And then we pay tax, then we pay our employees, and we think we're doing really well. And at the end of the year, we look like we've made more money, but we've actually got less in our pocket. It's a bit. They're saying, well, you know, why wouldn't I get a job with the government? Because at the moment, I'm not seeing the rewards of trying to be an entrepreneur in Australia, which is a bit sad. But coming back to like borrowers with rates, because I mean, I think definitely there's going to be another 25 points.
Yep.
It might be in May, they're saying, but I'll keep people posted on what I hear. And as I said, the banks have got plenty of economists. I've only got one I listen to, but I trust him more than the others. But what strategies can borrowers take if they're worried about? I mean, I think
Well,
the
I can
fixed
tell
rate
you what
market,
the smart borrowers are doing.
Yeah.
So smart borrowers are planning, right? Inaction creates anxiety. So if you're not planning, or if you've got issues or potential issues, or if you don't have a plan for 0.5% or a 1% increase, well, that's going to create anxieties. So the first thing is you've got to get in contact with your broker, your bank. What options do I have available? Have a look at your cash flow. Have a look at your budgets. Yeah. What can you do there? Are there fixed rate options available? I'm not guiding you on this, but if cash flow is really tight, there's potential to change loan terms, convert to interest only, seek additional cash funding. Like there's all these different options in the market to do it. But whatever move you make, it needs to be sustainable.
Yeah.
Short term isn't a solution. You need a long term plan.
And you know what? We have lots of conversations with people.
Yep.
We're not psychologists, but we've seen everything happen, and we can actually we can put to bed most of the things you're going to be scared of that's going to happen over the next 6 to 12 months won't.
Yeah.
So if you want to chat about your situation, where you are, what you want to do, just give us a call and make a time to come in.
Yep.
There's plenty of comfy lounges in my office. I've even got tissues if you want to have a cry.
Yeah.
So if you want to sit in the in one of the big gold leaf lounges and have a chat about where you want to go, they're more than welcome to come in and have a chat to us, aren't they?
100%. And as I said, and it's like all parts of my life, anything I don't act on straight away, it creates anxiety. So you've got to nip it in the butt, get onto it, contact whoever your broker or your bank is and come up with a plan. One thing I want to touch on, Troy, and it's something probably where there's a little bit of maybe confusion from the messaging or why we did. So we had rates in 2020, they hit the floor, right? And then we had a pretty steep increase over the next couple of years. 2024 was a hold. We had 3 rate cuts in 2025. And now we've got this bounce in 2026 with a rate rise. Did we reduce rates too quick? What's the reason for that?
I think they went too quick on rates.
Yep.
I think that, November 23 was the last time we had a rate increase, and then all of a sudden we hit these reductions quickly.
Yep.
I think if we didn't spoil everybody and maybe held back on 2 reductions.
Yep.
But I think the Reserve Bank's view was we're going to take a punt, get rates down, and get the economy humming again.
Yep.
I don't think the government listened, and I think the government kept putting a lot of cash into the market.
Got it.
So, and what they talk about now is, well, back previously, inflation at 6%. Don't disregard that was COVID. That when there was a lot of free money getting spent.
Yeah. And
I think governments got used to spending money after they saw what got thrown out in COVID. They just think they can throw money into the market. But what they're seeing now, it has a huge effect.
But inflation increases assets, doesn't it?
Yeah, and it increases tax.
Got it. But cash flow wise, you're getting squeezed.
Yeah, you're getting squeezed heavily. Yep. So I come from an era, when I first started as a young guy in the bank, we had double-digit inflation, which was ridiculous, double-digit interest rates.
I've heard the stories.
And double-digit unemployment. So unemployment, having it too low is not a great thing because it puts pressure on wages.
Yep.
And that drives inflation.
Yep.
So if we don't nip this in the bud now, inflation at over 3%, if we have that in October, we're going to have a lot less in our pocket. Even if you had lower interest rates, you'd be doing worse. So we've got to nip this in the bud now and get below 3% quickly and get down to 2.5%.
Got it. And one thing that will happen, and I should touch on this for borrowers, it's very important, is that if you are currently pre-approved and looking to attend auctions, your interest rate is actually increased, so your borrowing capacity is going to come down. At the point in time that lender passes on that rate increase, the actual amount you're approved for with most lenders will reduce. So very important or critical before you go to the auction or before you put that offer in is to check in with your lender and ensure that the amount you're approved for is still valid or what is your new maximum borrowing capacity, because that could catch people out.
And if you're coming in to see us, I'd say, what's my borrowing capacity with one more increase and two more increases over the next 6 to 8 months? So I know where I sit in April, May.
Yep.
But you know what? It is what it is. And if you're going to jump into a market, waiting, there's not going to be, there's not going to be a 30% drop, like people expecting you're going to jump in, because that I've never seen that happen across the board in the residential market in Sydney particularly.
Cool.
What about we talk about something else that's popped up, and we've been around a long time?
Yeah.
SMSF lending. And I thought about this the other day. Yep. We were a lender once in another life called MAS, and we actually were the first people to start writing residential SMSF. It was an ING wholesale, so we used to borrow money from ING Bank, and we had SMSF borrowers. And I thought about some really good, and I was like, oh, why would you pull your money out of super and manage it yourself? So I was talking to you the other day, and I said, I remember people that pulled out $400,000 or $500,000 in 2007 and bought really good residential properties. Like I think they could borrow up to 70%.
Yep.
And these people are pushing 65 now. It's a great story. They're going to have close to $3 million in super if they sell the property. $3 million in super, and these people are like PAYG workers that made
what'd they pay for it?
A ballsy call. I think they may have paid like $925 or something at the time. They had cash. They took cash out of there. They lent money to super, took cash out, and well, if you look back to 2007 now, it's a no-brainer where property's gone. But to get that much money into super in a tax-free environment, they're going to have a wonderful, like at 64, 65, they're going to be able to stop now and have a pretty wonderful life. So ballsy call, but super lending sort of it comes.
Well, you make
and goes.
your own luck, don't you?
I think the first time we got a bit confusing.
Yep.
Those people made a conscious decision and did their research, but then it got misused. A lot of property spruikers, as I call them, and people that are going to make you a gazillion dollars, decided to use super lending to drive customers to buy property.
Is that why the major banks got out of it, do you reckon?
They all pulled out, didn't they?
Yeah. So historically we had the majors, and then we had ING, Macquarie. All of these players were in the super in the super lending market. Yeah. For whatever reason, they've all pulled out, and we're really only playing in the non-bank space. Just this week, AMP actually announced that they're going to re-enter it after a few years out of the market. So they're seeing that there's certainly appetite for SMSF lending.
Yeah. But the good thing was the non-banks always drove innovation in this market.
And competition.
Low dot lending and competition. But the reason the major banks got out of it got too messy.
Yeah.
I think it was set up. The great John Denovan, who was a very famous solicitor, set up SMSF lending for ING. He's a great man. He was one of the most innovative blokes I've ever met for a lawyer. But he used to love driving change. And if you're listening, John, hats off. We'll have to catch up for a coffee or a glass of red one day. But he drove it. But then all of a sudden it got very lax. The compliance, there was a lot of compliance around it. How you have to manage and get the audits. And I think the major banks thought it's growing too big. But I don't think a lot of these customers now. The early ones had it set up properly, and I think a lot of the compliance as we've seen, it got very loose.
Probably for the percentage of the amount that they were writing compared to their normal flow, So the amount of time spent per transaction for them was maybe not worth the squeeze.
And I think they got scared off because big banks cop it. If someone makes a mistake, which is usually the borrower's mistake, it'll be all over the news. And I think the big banks thought we better slow this down and move out of it. I think they saw a lot of property brokers putting rubbish into people's super properties under the guise of helping wealth creation. But it was just like wealth creation for them, not the client too.
So if mum and dad goes to a property investment seminar, for example, they end up with one in their individual name and two in their SMSF. And it's like, how did that just happen?
How did that just happen? Well, it hasn't changed. I mean, we look at social. This is one of the reasons we want to do this podcast.
Yep.
Is that I see a whole lot of people on social. Everybody seems outraged on social media.
Yep.
Especially, I don't know why they're outraged about finance. It's a pretty benign topic. They get outraged about what the banks are doing, and then we've got really good banks in Australia, by the way.
I've got my take on banks, right? Yeah. And we're getting off topic here, but there's a lot of bank bashing going on at the moment. And from a customer experience point of view, we've got to remember, we'll talk about COVID and different times in there. Yeah. What an unbelievable job the banks did during COVID to get people to the other side.
Well, our four major banks are the best in the world.
Yep.
So I can attest to that. I mean, and when we wind back the clock one day, I can talk about my days at Westpac almost went broke. You don't want that to happen again.
Yep.
We can talk about that. I think their shares went to 240, which was a good thing for people that bought in and held on. Kerry Packer almost bought Westpac. But coming back to all this outrage and that, I think it's just changed. People market on on social media now. In the old days, mum and dad would be walking down Cavill Mall, go to the Danish ice cream shop.
Yeah.
All of a sudden, they'd be at a free breakfast and they ended up with 2 properties on the Gold Coast. If they held on for 25 years, they got out of it. But a lot of them just paid too much.
Yeah.
And it was ridiculous. It was the old 2-tiered marketing.
Yeah.
A lot of them ended up, we saw it, a lot of people ended up in the middle of like that between Brisbane and the Gold Coast.
Yeah.
The fact they've held for 20 years plus, they've done really well. But
for the people that couldn't hold on, they've torn up.
For every one that held on over the time, 2 sold.
Yeah.
And it wasn't a wealth creation. The only wealth creation it was for was for the people selling the property and marketing the property.
So then talking about SMSF lending, there's 2 channels, right? You can actually borrow in your SMSF to purchase a residential property, and then you can also borrow in your SMSF to purchase a commercial property.
Yep.
And the typical transaction we see from a self-employed client is, say, the factory. He's got a panel beater and he wants to buy his factory. So that's one, and he's meeting with his accountant and financial planner, gets the appropriate advice, and he ends up buying the factory in his self-managed super fund.
Yes.
And what actually happens there? They have their superannuation in a retail fund. They set up a self-managed super fund, deposit the funds into there. That's where you use the deposit from your super fund, and the bank can leverage up to, say, 70 or 75% of the asset value.
Yeah.
You pay yourself the rent, and then obviously continual superannuation contributions.
I'm loving commercial SMSF.
Yeah.
I think it's a really good product for people out there that want to look at buying a factory or a unit.
And have control over their business and where their business operates as well.
Yeah, exactly. And having a yard, having a bit of hard stand. I think I think the commercial space is in for another kick in that smaller space where it hasn't really done a lot for a long time.
Yep.
I think in the next 18 months it's due for a real kick, and I think the best way to have a look at getting into it through that commercial SMSF.
Yeah. Getting the right advice and having the right team, accountants, financial planners, and make sure they're the ones steering you down that path.
Yeah.
And then obviously residential, and for those residential investors out there, again, similar sort of method. It goes on the proposed rental contributions and then your superannuation contributions. Typically, most lenders will lend up to 80% of the asset value, depending on location, and then the rent and your contributions will service the debt ongoing.
But we can come in and have a chat about it and have a look at. We know a lot of the commercial agents out there as well.
And it's it is important, and one thing to touch on, there's something called a liquidity requirement in self-managed super fund lending, and that is about having surplus funds in the fund following the purchase as well.
Yeah.
And that's about being smart and working with your advisors there, ensuring that there's surplus funds in the fund.
We've done that many of them. We can help you there and put you in touch with it. If you don't have the right people, we can give you an option on a few people to deal with.
Yep.
But should we cut to a break and get a word from our major sponsor, FirstPoint Mortgage Brokers?
Let's do it.
Are you in the hunt for a home loan, or Brian looking for a better deal?
Look no further than the award-winning team at FirstPoint Mortgage Brokers. Check out all of their 5-star reviews.
Whether you're a first-time buyer, investor, refinancing, or self-employed, FirstPoint get it.
They don't do this just for practice, sugar, like your goal kicking. They just do mortgages better.
With FirstPoint Mortgage Brokers, don't just be pretty sure, be certain you're getting the absolute best deal.
And contact them today, firstpointmortgagebrokers.com.au.
Welcome back. Troy, I want to wind back the clock. GFC, something I remember vividly. I was 3 years into my banking career.
You were a kid then. What were you, 20?
I was 20. I started work at 17, straight out of school, 5th of January, into a company called Home Loans Limited, which is now Resimac, multi-funder lender. We really felt it, but I was 20 at the time. What I want to know, so with 2007, 2008, when did you first realise that this isn't normal?
Well, I had a trip booked to the US, and it was a round the world ticket, and it was first class. Someone else was paying. It was always a dividend minimisation program.
Were you at Home Loans Limited at the time?
Yeah. And Challenger had put a big chunk into the business, and everybody wanted. And I was like, we're not going to cancel the trip, because we used to go over every year and talk to
US banks.
US banks. I used to go over and make a point of it with Brett and travel through the UK and talk to Barclays.
Yep.
So we went on our merry way. It was 07. It was September 07. It was all happening. Because at that time, we had a big wholesale facility through Adelaide Bank. And I remember talking to Jamie McPhee, the CEO at that stage, and he said, we've got an issue.
Yeah.
We've got an issue. And they were pretty switched on, the Adelaide Bank guys. They were a small bank. Guys, we've got an issue at the moment. There's a liquidity crisis coming. We think it's going to get worse. We think one, there'll be no funding in the market to fund ourselves or fund mortgages. And two, settling the bank was hard. Like, so if I just tell you, banks are very much similar to a bank teller. A bank teller in the old days had a teller's box with cash.
Yep.
At the end of every day, you had to settle. You hadn't given out more than you'd taken in, and you had to not have you had to balance it. So every night, a bank balances with the RBA.
Yeah.
So
Square the ledger.
and they go and borrow from the short-term market. So every bank in the world borrows from a short-term market globally. The short-term market stopped. No one could borrow money. So banks started not to trust each other that they could settle. So a lot of these banks couldn't settle. So all of a sudden we woke up and there was no money in the world. But it was all the investment banks in the US, and I'll take you through when I was there, was sort of hanging on, but they were making out they were going to get through it. So I went from Barclays. I'll tell you the story later on, but go on.
Liquidity disappears before it meets the headlines, though, doesn't it?
Yeah, that wasn't. Everybody's going, oh, it's all right. Everybody wanted it to be a glitch.
Yep.
We'd never seen anything like it.
Yep.
But if you watch the movie The Big Short, it gives a really, really small picture of what happened. But basically, what happened. This is the history of it. Banking was a pretty boring industry. We had 4 major banks, a few building societies, a couple of credit unions.
Yeah.
And all they did was lend off their deposit base. So if they had deposits, they'd lend it, they'd make huge margins. In Australia. In the US, they always securitised their mortgages, and it was a bit of a messy market. It wasn't that sexy. But in Australia, it was like that. Then all of a sudden, John Simon came along with Aussie Home Loans, and it was like the perfect storm. This word called securitisation came out. Adelaide Bank actually funded him in the early days, and he went to Macquarie.
So he was funding it significantly less than what the banks could offer?
2% at one stage.
Yep.
2%. It was great. And all of a sudden, the banks got rid of all these old bank managers. They had nowhere to go, so they become mobile mortgage lending offices. So it was like the perfect storm.
So that created the broker market.
That was the precursor to mortgage brokers.
Yeah.
And it was like the Wild West, but selling something 2%, and the banks thought these guys would go away.
Yeah.
Now I remember David Murray, who was second in charge at Commonwealth Bank in those days, said we need to reduce the mortgage rate by 1.5% and not let these mortgage managers and securitisation get in. They all laughed at him. He would have actually finished the market off, and it may have never got to where it got to. But securitisation is a word where they used to. So what happened was a bank might have lent $1 7 times.
Got it.
Now it's 21 or more. Because what they did, they started working out, as in The Big Short, we'll package up. And Australian mortgages are desirable because our default rates are low.
Yeah.
Everybody still loves Australian mortgages because over the GFC, no one lost money on Australian mortgages.
Pretty robust banks, aren't they?
Yeah, and our credit, Australians always pay, which is a great tip to Australian culture. We always pay when we can. So securitisation came in, wrapping up our mortgages. But what happened in the US? They were forced to lend to everybody by the government. You got to fall, So the investment bankers got smarter. All these guys at the top end thought, hey, let's go to the mortgage part of it.
Yeah.
Let's go and do this low doc lending, and then ninja loans. No income, no job, no assets.
What percentage of loans do you reckon Lodoc got? That would like a much higher percentage than what they would be today, like a significant higher amount.
I had to guess. I reckon 18%.
Yeah,
it was a lot.
That's
lot of people
too much.
But it was like you remember, we had it in Australia. We were doing it without. With
Lodoc products.
You could press hard sign here and borrow 75%
without showing much at all.
Yeah,
Yeah.
And
it's madness.
Yeah, all ours held up, but in the US it went tits up.
Yeah,
that all the mortgage-backed securities for these bonds they issued started to default. So the first thing that fell over was a big bank called Bear Stearns. These things had been around for like hundreds of years, and they got into dealing in these mortgage-backed securities. It became the sexiest thing on Wall Street.
And were you there at the time? When
I didn't. So I did a tour with a young bloke called Nick Smith, N-I-K Smith, and you can Google him. I reckon he'll come up. He was a great young bloke, but he wasn't worried about all the shit mortgage securities he sold. He goes, man, all the study I've done to get where I want to do, I could have been an orthopedic surgeon by now. He took me out for dinner and was telling, he goes, this whole thing's going to blow up.
Yeah.
We've sold so many shit bonds to people.
He could see
this whole thing's going to blow up. I can see this coming. We're not going to be able to pay the interest on these things.
Yeah.
He essentially then got a job back at Bank of America later on and bought all the good ones he knew, so he killed it.
Yeah.
If you're out there, Nick, you probably won't be listening to this, but I hope you're doing well. But so Bear Stearns, I went there and there was this eerie feeling. I went down on a dealing room floor of a massive US investment bank.
Yeah.
And it was empty. And there was a bloke called Tommy Murato, I think, who was the gun of all this. He'd got sacked about 2 weeks before. He had like Grateful Dead guitars in his office on the wall and everything else. So you could just tell it was like the halcyon days had gone. It was about to fall over.
Yeah.
Then we went to Merrill Lynch, and met a bloke there called Anthony Herman, who was I think he lives in Australia now, but he married an Australian bird in Brisbane. and he basically said this thing's going to blow.
Yeah.
So we knew we went there to actually to get our own funding to lend to become a big no-doc lender in Australia. We thought Brett and I thought we've got to jump in on this.
So you went there to get more cash.
Yes, we went there to get cash ourselves.
And you've come back
We've
realising
come
there's
back
not
and-
going to be anything left.
Well, we came back and said, you know what? We've got to look at this mortgage broking market.
Yeah.
It's still unsophisticated, but we've got to look at building our own retail brand. Being a wholesaler, and you were working there.
Yeah.
Being a wholesaler, dealing with mortgage brokers and lending our own money, as a small niche lender, it's too risky. We could go broke, and we don't.
And we got capped. I remember we got capped
Well-
the amount we could lend.
Well, we had a wholesale facility with ING, and we got capped. We actually, luckily, that we didn't get kicked off. We had money we could lend. I think we got capped at about $8 million a month. So really, once you'd done 2 weeks,
Yeah.
the first week and a half in, we didn't have anything to lend the week for the next 2 weeks afterwards. So we had to find something else to do.
Yeah.
Hence, FirstPoint's the early days of FirstPoint started to be born. That we thought we need to be close to the customer because
Yeah.
one, we actually like customers, and we didn't want to just deal with basis points.
Yeah.
And it just made sense, and we didn't have any other options.
Yeah. That's right. And we had the skill set to do it. We've all come from a
Yeah.
credit background. We're all technicians as opposed to
Yeah.
salespeople.
Yeah.
It just made sense to
Well,
do it.
Yeah, it did, and they were good days. But if you look back now, I didn't know the GFC was coming when all those long lunches
Yeah.
stopped. It seemed to be really easy in those days.
And then just quickly touch on margin lending and how and the sell down. And obviously we don't have the tech that we've got now. So quickly on margin lending, if you've got $1 million in shares, you might be able to leverage up to say 60% of the asset value.
Yeah,
Now, what happens in a sell down when
Well,
something like that happens?
it happens regularly. When you now, I think the gold price recently has gone up and spiked down, and it's probably more complex now because margin lending's a good thing. Leverage equities in Australia were the first people to do it.
Yeah.
And Adelaide Bank bought them. I don't know where they landed it. But they used to lend you like 70% on a share.
Yep.
But once the LVR of 70% borrowed against the shares, unless you could tip money in within 24 hours, they just start selling your shares down.
So as the asset value reduces, you've
Yeah.
either got to tip in cash,
Tipping cash quickly. And
or
if you
they
haven't,
automatically sell you down.
yeah. And a lot of the time, and even through the GFC, no one's got cash.
Yeah.
Right? So all of a sudden, the computer trading, which is now going to be AI trading, just starts to sell down. Now, I'm wondering whether AI might be smarter and might know not to cause a market collapse.
Whether it has the intelligence to say, hang on a second.
Because computer lending was pretty dumb when you look back where we are now.
Yep.
Computer trading then was like, okay, you've dropped below 60, you're up to 75%, we're selling 5% of your portfolio down.
But that's all we had. That was the most advanced at the time.
We thought it was really advanced, but what it was it was proliferating a massive market correction and then a crash.
Yeah.
So I think it's going to be interesting to see where AI takes all this.
Yeah.
I mean, we'll talk about AI in our industry and how we're going to embrace it as well. But
Yeah.
the GFC, what it says is where we are now.
Yeah.
When money runs out, it happens really fast.
Yeah.
And you want to have good relationships, or you always want to have a little bit packed away for a rainy day.
Yeah. Yeah. The treasure chest, 6 months, 12
Yeah.
months repayments packed away
Yeah.
to the side.
But not for homeowners particularly as much as small business.
Yeah.
Always think, and if you're a larger SME that's got a big relationship, but you're doing annual reviews with your bank,
Yeah.
The Aussie banks should look after you generally, but never take it for granted. They're not going to say, oh, look, we want to have a big principal repayment and you haven't got it there.
But that didn't only hurt people with debt, it hurt retirees as well.
Oh.
What they thought they had compared to what they ended up with.
It was, funnily enough, it was always a lot of European doctors and a lot of big funds, a lot of big super funds that you'd think were smarter in Europe bought shitloads of these mortgage-backed securities and wrote
that
them.
right?
Yeah, wrote billions off.
Yeah.
So it was gone. But the American mortgage market's all a 30-year fixed rate market and it's all still securitized.
Yeah.
Like when I used to go
It hasn't
there,
evolved too much, except probably the ninja loans, they might have cut that back a little
they've
bit.
tied it back.
Yeah.
I mean, but their property market is never as buoyant as ours.
Yeah.
I mean, in the big cities it is, but you go to other areas, it's very affordable.
And then anyone that's taken, say, a 30-year term recently through COVID, they're like transactionally, surely their transactions would have to be down. Why would you break a 30-year fixed rate at 2.5%
Well,
or
they don't.
3%?
That's why the market's slow. Like,
Yeah.
they can break a fixed rate with no penalty over there at 30-year fixed rate. So they have what they call refinance boom. So they'll get one now.
Yeah.
So if you've got a 30-year fixed rate, you're living in a house you don't mind, and you're at like a 2.5% rate for 30 years, you're not going to refinance.
Why would you move?
Yeah, you don't.
Yeah.
You're not going to go to like a 9% rate.
Yeah.
In a new suburb in a house you like, because what's the point?
Yeah.
Yeah,
All
but
right.
GFC, interesting times. We'll wind back the clock another time on something else.
Yes.
What do we do next?
I I'm going to sort of pop the bonnet on FirstPoint a bit, and I want to do this each episode because we are small business owners, and we ride the wave like everyone else. We invest in areas we're not sure of. We try new things, and if it doesn't work, we keep pushing, and then we work out, hey, we're just going to write that off and go into something else.
Yeah.
Today, I want to talk about scale. Scale is a sort of a buzzword getting around at the moment. I really want to know sort of the shape of FirstPoint and the purpose behind the way that we've built, and we've sort of initially started to be small, very very customer service orientated, and we're going through this growth, but we're not accelerating at a pace that say other business would want to accelerate. Just sort of talk us through your theory behind that and why we're taking that approach, building it onshore as opposed to offshore.
Well, scale's a wonderful thing, but, I always say volume's for vanity and profits for sanity. So one thing, you owe it to your staff and everything else to have a business that's successful and makes money, because when it's perceived to be successful and loses money, the music stops pretty quick. But, mate, my theory has always been, when I was growing up, I looked at where my family banked and my grandparents, and St. George Building Society had this wonderful, reputation and legacy in the area. Everybody loves St. George Building Society.
Yeah.
And they came from really humble, small beginnings, and they really never forgot where they came from. So I always looked at being local, having a brand local, and just being the biggest fish in a smaller pond, but being I always put it to brand, but being well respected and standing for something, not falling for everything. And then as we went down the path, I looked at another business, which is Latrobe, which is a huge lender now.
Yeah.
But Latrobe started as like a little what they call a terminating credit union in Traralgon in Victoria.
What year was that?
Oh, I think it was 1954. So I always say Latrobe was an overnight success. It started in 1954. And it started just doing housing loans for local people in Traralgon, and it grew and grew and grew, and it found its way into the commercial market. And as the people in the business grew, it made some really smart decisions.
It's repetition of doing the right things.
Doing the right thing and doing it well.
Yep.
And not falling for the next sexy thing and growing fast. I want to do this. It's like you've just got to do.
Yeah.
If you keep it boring, but you're consistently boring, but you're consistently really good, you won't fail. Yeah. And you know what? You won't be waking up in a cold sweat every morning. And the people have a path. Because my theory is, if you're offshoring, how do you...
Next man up. Where does that come from?
Exactly. It's the next man up. It's like, Trent Robertson, shout out. It's the next man up mentality. And like, you've got to, as you always said, you've got to have touched like 500 files so you know what you're doing.
Yeah.
People say, I want to be a mortgage broker. Oh, well, you can skip every other. It's like saying I want to be a motor mechanic, but I was an accountant last week. Oh, can you pull the engine out?
Yeah.
Well, I can pull it out. I don't know if it's going to go back in.
It's true, yeah. And there's so many, and like any business or any world, there's so many different parts to what we do. And one or two times you might get it right, but what happens with the third application that you don't know, you sort of don't know the answer to? Or how can you sit in front of an accountant if you can't understand a profit and loss or balance sheet or the performance of that business? But
we've also made a lot of mistakes in tech, especially because we thought, we're falling behind. And this is where I'm worried with AI. We are dabbling in it like everybody else, and we're lucky enough to have our hands in a business with a guy that knows a lot about it. But I'm not going to.
We've spent some money trying to build it ourselves when we should have been smarter and just white labelled what the techos build.
Buy. For us, our size, don't buy.
Yeah.
Because you know what? Bolt it on. When it doesn't work, get the next best one. Because when you start building something, a legacy, 10 years later, it's like a clunker, and there's 10 things better out there.
Yes.
And just bite the bullet and burn the cash, and within a week you get over it. You have a laugh about it and bring it up every now and again, but you just got to suck it up. But don't be scared to take a punt and invest in the business.
Yeah.
And don't put your head in the sand blindly and say, they're going to fail because they're going down that. If someone you respect is going down that path, you better start looking at it as well.
Yeah. And then talking about scale itself, and we're really particular about this. If we had 10 customers or 100 customers, we need to ensure that we've got the framework and the infrastructure to be able to service them the same.
Yeah. Yeah.
If you get to 50 customers and they're not getting the same experience that the 10 customers were, well, we've got to look under the hood and say, all right, where's our holes? What have we got to do?
Yeah,
what do we have to move?
Yeah, you want people to say, I'm with FirstPoint. It's like the old St. George Building Society. You want people to know they're safe and they want to, they enjoy popping in and they enjoy the conversation.
Yep.
Because it's important. I mean, look, we're mortgage brokers. It's not sexy, but we've still got reasonable chat and we've still got reasonable ideas.
Yeah.
And if we can keep you on the straight and narrow and give you peace of mind, we've done our job. Absolutely. On the way through.
Hey, that's enough for today.
Yeah. Well, we got through episode 1, mate.
Yep.
Ground zero. Well done. Good idea,
Episode
Chris.
2, we're going to talk about Greece.
Yeah.
Um,
Holidays there or
no, not holidays there.
the crisis they had?
We're going to talk about the crisis. We're going to talk about more things in the market. We are also going to talk about buyer's agents and the value that they can add, and some other things as well.
And
So-
we're going to get guests on eventually.
Yep.
When we find some, we'll get some really, really, really smart ones, some really weird ones, and some people from left field.
Yep.
Okay. Catch you next time, guys.
That is all.